Welcome to FreightWaves Today. I'm Craig Fuller here with Julie Van de Kamp. Julie, this is such a news-packed time of year, time of the quarter, because we get all the earnings reports. It's hard to keep track of it. We have a ton to talk about today. And we have a special guest, Josh Phelan from J.B. Hunt will be here. Todd Maiden's going to break down the Knight-Swift earnings, which everyone's concerned about. Tomorrow, we're going to break down the rail. We will talk a little bit about the rail reports, getting some amazing earnings reports from the railroads. Nobody should be shocked. I mean, the great thing about the railroads is that you do see, you get this regular traffic data, so you know how they're performing. They have such great business models. We're going to break that down tomorrow. We also have our virtual rail, Future of Rail Symposium next Tuesday. It is a jam-packed lineup of speakers. Frankly, when I was looking at this is the roster of who's who in the rail industry. And these are obviously highly influential folks across the global supply chain. One of the other things that I think is really interesting is we're getting some earnings reports, and CSX had their earnings report, NSUP, definitely benefiting from a lot of the AI build out. These are AI stocks, believe it or not. And maybe more attractive because they actually return capital, they generate a lot of capital. Railroads are amazing businesses.
I know, I was just thinking about that. Like, you know that they operate such substantial margin compared to trucking companies.
40% margin.
And then you actually look at the earnings and it's,
and we're going to talk,
59% OR, 61% OR, 67% OR, and then we're talking about how great a 91% OR is for a trucking company, and it just
97 OR,
the
world that you and I lived in, and just trying to bleed out pennies. That's how all the truckers feel. Look, we're going to talk to a company who's not a railroad, but certainly operates like a railroad, J.B. Hunt. We're going to hear from Josh Phelan. Josh has ran pricing. He's been all over the business. He now runs their for-hire, over-the-road business, which is the most brutal. It might say a lot. I don't know how you get that job. You're either a damn good operator and the best in the business, or they're like, look, you get to suffer the over-the-road business.
Either a compliment or a punishment.
It could be both, and maybe it's a bit of both. So we'll hear from Josh here shortly in the show. We also had Tesla's production numbers, earnings, and of course, if you're interested in electric semi, Tesla's talked about the fact that they are finishing out their plant. Any timeline, Julie, on that?
Yeah, so what I read in the earnings is that the factory is complete, that they're expecting production targeted to begin at the end of 2026, and they're putting real-time, actual numbers around it. They used to be very vague, but this time they were a lot more specific. And you can tell by their CapEx surge as well, with the CapEx expenditures up 142%. A lot of it was on ramping up for production of this.
Well, I'm eager to hear, and Josh will probably have perspective on electric semis. I know J.B. Hunt has,
has everything.
All of the different technologies that come out. J.B. Hunt has been on the leading edge of the conversation around alternative fuels, testing technologies. We'll hear from Josh because he's got a perspective on that. We just got a jam-packed show. This is the gift that keeps on giving. And but let's get into the Morning Minute. Here are the headlines.
We kick things off with a milestone that Wall Street has been waiting for in the autonomous trucking race. Pittsburgh-based Aurora Innovation launched its second-generation driverless hardware on Wednesday, deploying it across its commercial network of 10 driverless freight routes in the U.S. Sunbelt. Unlike its first-generation trucks, the new fleet is built to run with no passive observer at all, erasing what Morgan Stanley equity analyst Ravi Shankar called one of the last remaining asterisks around the technology. The new platform is engineered for a 1 million-mile operating life and is specifically built for volume production rather than pilot-scale trials. Aurora is leaning heavily on manufacturing partner Roush, which is targeting an annual production run rate of 1,000 trucks by year-end. The Aurora Driver has logged nearly 440,000 cumulative driverless miles as of the end of June, and commercial momentum is building, underscored by one customer's recent plan to purchase 500 Aurora Driver-powered trucks. Meanwhile, the nation's largest truckload carrier is declaring that a structural recovery is finally here. Knight-Swift Transportation reported second quarter adjusted earnings per share of 63 cents on Wednesday, smashing the consensus estimate by 12 cents and coming in 28 cents higher year over year. CEO Adam Miller credited aggressive regulatory enforcement by the Federal Motor Carrier Safety Administration and the Department of Transportation for forcing out non-compliant capacity and creating what the company called a rapid progression in truckload market conditions. Contract rates climbed throughout the quarter, with revenue per loaded mile accelerating from low single digits in April to 8% in June. Knight-Swift's tender rejection rate was twice the industry average, and the carrier is now getting double-digit rate increases on recent bids. Miller believes the regulatory cleanup is durable and raises the floor for rates in the next downturn. Finally, over on the rails, CSX is riding a powerful volume rebound to beat Wall Street expectations. The Jacksonville-based Class 1 railroad reported second quarter revenue of $3.94 billion on Wednesday, up 10.1% year over year, while earnings per share came in at 54 cents, beating analyst consensus estimates by 4.2%. Carload volumes improved by 6.1%, a dramatic swing from just 0.1% growth a year ago. The railroad's operating ratio improved to 61.7% from 64.1% in the prior year quarter, reflecting better cost control and operational efficiency. Intermodal volumes have been a particular highlight, with analysts noting a surge in intermodal traffic driven by strengthening demand across consumer goods and industrial shipments, moving through CSX's Eastern U.S. network. Free cash flow swung dramatically from negative $115 million in the second quarter of 2025 to positive $687 million this quarter.
So Julie, Knight-Swift blew out their earnings expectations. Yep. Fantastic report. I don't know that we're surprised in that. A couple of things that I did take away. One is the comment about the fact that their tender rejection rate is twice the industry average, which is implying 30% rejection rates, quite substantially when you think about that. One of the things that I thought was interesting was that you could take away that they're not seeing substantial volume increases. It's really just operating efficiency. You mentioned how selective Knight-Swift tends to be, and it seems like they're getting a lot of operating efficiency. One of the other sort of takeaways here is their seated truck count is actually down, which means, and they've talked about the driver situation, difficulty of hiring qualified drivers, just getting more difficult.
Yes, I mean, and I talk about it at the Sonar update as well, but that they specifically say they don't have any plans to add trucks right now, that they would rather focus on efficiency of their current fleet and driving higher utilization there, particularly in such a hard hiring environment. So I think that speaks exactly to what we've been talking about, this being a sustained upturn, right? That this is not just a quick cyclical change in the market, but significantly longer.
Yeah, I think it's a real interesting sort of takeaway. It does, one of the things we've gotten channel checks that during sort of the doldrums of the freight recession, Knight-Swift was just parking trucks. They were not running them. They had some brand new equipment. They were putting them against the fence. They didn't want to put miles on them. It was more efficient to take trucks out of the market than to run them at losses. And I think what we're seeing now is that they're the very front end. I think the takeaway from this is they believe that we're at the very front end of the overall freight recovery. And that's, I think, is probably the most important piece.
Yep.
So our next guest, we have Josh Phelan.
We have a fun surprise.
We have Josh Phelan up here. Josh, how are you, sir?
Good. How are y'all?
Doing well. So tell us, you run J.B. Hunt's over-the-road business. We've been joking about the fact that you're either the best operator in the business or they give you the stuff that needs the cleanup. So what's the sentiment in a business that operates so efficiently?
Well, I think it's certainly the latter, Craig. You know that. And by the way, y'all are getting really good at this. It's good to see y'all, even though it's on a really small screen for me. I think it's obviously an interesting time for being in the media. Earnings season, it's always fun 3 to 4 weeks. And then, if you compare it to maybe the past 8 to 12 quarters, maybe there'll be some more new news this time around. I'd say the trucking market has certainly seen a significant change than where we were prior year. You know this, your audience knows this, spot capacity rates. I think if you look at the NTI measurement, Craig, in June, I think at one point was up 60% year over year, which is a drastic change. From a JBT perspective, our over-the-road segment, we've been navigating that marketplace. Our model is a little different. We have a large fleet of independent contractors that are under our authority, but we also utilize third-party capacity. And so, providing drop trailer service for our customers in a heavily contracted marketplace, obviously that dramatic increase we saw in spot capacity rates had a negative impact on our short-term earnings. And I think what we're seeing is, and we've talked about this before, certainly the change in the market is driven from the supply side. I think you were talking about how Adam at night mentioned that. Just the continued regulatory enforcement and how much of that will continue and even strengthen. I think if you talk about the magnitude of the increase we're seeing on the rate side, though, I think that's really driven from, the direction of it is because of what's going on with supply. The magnitude, to go back and where the industry has been really for 4 years on very compressed margins. Cost inflation has been up quite a bit. I think if you go back to 19, you'll see it quoted anywhere from 48 to 60%. On a cost per mile basis to operate a truck, and the rate environment that we've been in inside the marketplace, same period comparison might be up 5 to 6. So really compressed margins have led to a whole lot less investment. And then I really think is driving the magnitude of increase you're seeing because, quite frankly, the industry needs it to start reinvesting in their equipment.
So, Josh, I think that's a real important point, is just the lack of investment. And we got the report from Knight-Swift. They've talked about the fact that they would prefer to not expand the fleet right now because they would prefer to operate their trucks more efficiently. We saw that their operating ratio and their over-the-road for-hire business dropped by 300 plus basis points. So significant improvement, but it seems like the desire is all about operating efficiency. I mean, they're at 30% tender rejection rates if you take it twice the industry average, which does suggest that they're being far more selective, but they're not leaning into growth. I think a lot of what they're talking about, what Knight-Swift talked about on the earnings call, was just the lack of driver availability, the inability to recruit drivers. What is it you're seeing in the market compared to perhaps past upcycles in terms of driver recruiting?
Yeah, I mean, we are seeing the driver market tighten significantly. The first thing we saw was the third-party capacity market tighten, and that quickly leaked into our available pool of drivers. I think we talk about our need quite frequently, and we've seen our need increase. Part of that's self-driven, right? If you have growth's a good thing. That increases your need. But if you start to see more opportunity for drivers to jump around, you might see turnover increase. I can't speak to Knight specifically, but if you go back and think about where we've been for 4 years, our concern, and we've done a really good job of cutting costs, and we've talked about that publicly. Our concern was, we never want to cut into the muscle. And you might have had carriers out there that actually did that because they had to survive. If you start cutting into muscle and cutting, it's going to create more of a lag of your ability to grow when it's time to grow. I think could be one issue, a carrier's facing. The second is we still got to get our returns, at least on paper, and a great line of sight of saying, okay, I have comfort and I have conviction that, one, I can reinvest in any of my equipment that's cycling out, and I can get the returns to where they need to be, where I can add CapEx to this. And I still think we're in that period. I know spot rates are up. I know contract rates are moving up based on the data that we see, but there's still some room to go to get returns where I think they need to be to have a healthy appetite for growth in the truckload space.
And as part of that driver pay, I mean, as you're seeing this recruiting and retention environment get significantly harder, are you guys looking at driver pay? What are you seeing in the industry? What are you hearing? Obviously, that increased costs, exactly to your point, before you're ready to grow. So can you talk a little bit about that?
Yeah, we are seeing increased driver pay. I don't think I can't remember what that index was, Craig, that y'all were talking about a couple of days ago. I don't think we're seeing it at that level, but we're certainly seeing advertising pay go up. We do our own channel checks and talk to our friends. How much driver pay is going to go up this year, I don't know. I think if you went back and looked over the last couple of years, that may be one cost that hasn't increased as much as the rest. What that would lead me to believe is with supply where it's at, with the driver pool shrinking as an industry, you're liable to see a pretty good step change needed in driver pay this year and into 2027, which again can kind of counteract, if you will, the amount of rate improvement that a carrier might need, because they need improvement to repair their margins. At the same time, cost inflation continues, and so that just compounds the amount of relief we need to go get.
But I think that's a positive thing, because I think one of the temptations that we see in every upcycle is that the industry overcorrects. They add way too much capacity. We can't have nice things, as we like to say, in trucking, because when the market is soft, you can't find freight. You have plenty of drivers for your trucks. When the market is strong, you can't find drivers. You have plenty of freight, but you don't have people to have seats. I think the temptation right now would be, and Dr. Jason Miller from Michigan State was on FreightWaves Today on Monday talking about the fact that he thinks that there's going to be this very quick desire among large fleets to overcorrect. That's not what we're hearing as our channel checks. How are you guys thinking about just growth in terms of the business? Is this a market where you think carriers are going to be far more conservative generally about adding trucks until they see sustained recoveries and driver availability? I mean, the employment number, Julie, I don't know if you saw the headline this morning, but employment, we've had a couple of really great employment data points, which everyone's predicting the AI apocalypse is going to destroy employment. That's not what the data says.
Yeah, I think there's a couple of things to that. We had some of our carriers in last week talking to them, and it was kind of a mixed bag, but the ones that want to grow, there's two things different. Maybe one thing different than the prior cycle is financing. Financing is way more expensive than it was in 2020. So they're having a difficult time getting actually money to go invest in new equipment. The ones that have that have had trouble finding the tractors. So I think from a small carrier base, and not to mention what's going on Montgomery and all the regulation impact, I think there's going to be more headwinds this time on at least the small carriers or new carriers entering in the space and growing their equipment. From a large carrier, again, I still think it will come down to the belief that we are on a more sustainable bull market, if you will, and that the returns can get to the level they need. I think you'll be more cautious. I think Shay mentioned this when she was on. We're all about growth, but we're all about disciplined growth. We're not going to just grow our top line for sake of our bottom line. So we want to grow. We're going to be very focused on where we do that, but we're also going to make sure we put our CapEx in the right spot. So if it still doesn't make sense to add capacity in the OTR market, we won't. We'll add it somewhere else. And I think you might see a little more cautionary investment from the large carriers. Never know, you may not. And I think from the small carriers, there's going to be much more headwind and more barriers to entry, if you will, than they have been in the past.
I mean, I do think it's interesting that over the last decade, the largest carriers have not been adding trucks. Like you can look at it as a general consensus, and we have this data inside of Sonar. In trucks above 1,000, if you take the cohort of 1,000 trucks or more in a fleet, that basically is almost flat. Like it barely has moved in the last decade. And it's telling us that really large fleets are becoming far more disciplined. Now, some of it's been the cycle itself has not encouraged them to add trucks, but companies that have all of the advantages, like a J.B. Hunt, like a Knight Swift, like a U.S. Express when it was an independent company, have chosen to sort of sit out the market and drive operating efficiency. Where we are seeing growth is in the non-core over-the-road business. Josh, we're giving you a little hard time about you're in the most difficult part of the entire enterprise. You guys had this amazing intermodal business that we joke that I look at J.B. Hunt more as a railroad than I do a trucking operator, and I mean that as a compliment, by the way. It is interesting because I think where the growth is coming from is in the non-solo OTR business. I think the large fleets have decided that that's a market they're willing to seed to some degree and then focus on other areas of growth.
Yeah. After a long day, I get in my car, I go home, and I always tell myself I work for intermodal, and it makes me feel better. You haven't seen much growth in the OTR market. You've seen larger carriers transition more to dedicated, which is a much more sustainable economic model. And I don't know if that changes, quite frankly. If we could start to see less volatility in the pure OTR market, I don't think you're going to see that grow. Now, we always like to say this time's different, and I'm not saying that, trust me. But if a few changes to how the market behaves in less wild swings, you can build a good business. And obviously, there's a lot of great carriers out there, Knight being one that know how to run trucks. But if you want to see that start growing again, we're going to have to see less volatility so you can actually plan a business around.
Trucking's a
I
great
think that
lifestyle
makes
business.
so much sense.
It's a great lifestyle business, Julie. It's not necessarily the over-road business as a public company is much more difficult, which is why I think the big public guys are looking for diversification.
Yeah, I mean, I think, well, so you mentioned earlier that you guys, even in your brokerage and in your over-the-road, highly contractual freight, right? With your large drop trailer network and your 360 boxes for your brokers. So what are you seeing when it comes to contract rates? You mentioned that you're seeing them finally inch up after spot. What are your anticipations there for the rest of this year and into 2027?
Yeah, I don't think they would let me talk about rates. Maybe they would, but I mean, we are seeing.
You don't have to give you numbers. Directionally, what do you see happening? What are you hearing?
We're seeing contract rates move. We call it a choppy market, and maybe that's a cop out. We'll have some successes, or we don't have some successes. What we're focused on, honestly, is making sure that one, we're taking care of our customers. So we're going to do what we said we would do, and we're focused on, accepting what we were awarded and honoring our commitments, but doing the best we can to work with the customers where we need relief. And it's not easy. It's hard conversations. Shippers are really stressed right now. Obviously, their budgets are being blown up. One, because of what energy prices are doing, and two, what's happening in the marketplace. And so we're trying to navigate that the best we can. Obviously, we posted a loss inside Q2. We've had a successful run inside JBT, our OTR segment. We've grown double digits, I think, for the last 5 quarters. So we've taken share, and our model that we use has really played out. We're just caught in that flip, if you will, of the inflection in the market, and we've got to fix that, and that takes work all the way around. Us removing costs, finding better ways to do it, trying to address business where we can the right way with the customer, and still focus on creating value for them the best we can, and what's been somewhat of a turbulent market over the past several months.
Josh, one of the things that we had JP Hempstead, who has moved on to, we'll say, better things in media now on Wall Street, sort of the intermodal of what we do here, making a lot more money, I'm sure, than being a.
Left. Where'd he go?
He's at West Brown Capital, which is one of the largest funds. By the way, it started by a former FreightWaves analyst, a market expert. Seth Holm went out and started, now one of the largest holders of trucking and logistics stocks in the entire world, based here in Chattanooga. But JP, his comment was that Hunt is viewed typically as a late cycle beneficiary because of the way that your business model has built. Intermodal tends to have less movement in price. There's really a big spot market in intermodal, but that's not what I would say. Is, I mean, it looks like we're still in the early innings of the cycle. I mean, we heard from Knight Swift about the fact that they're anticipating continuation of tightening and tighter capacity. In terms of just overall cycle perception, where do you guys currently believe that we are? Are we early? Are we mid? Are we late?
I think I believe we're early. Again, I can't predict how it'll play out. I think Spencer said on our call last week, the demand for our services is really strong, even though you can debate whether demand in the market is really strong. As even from a spot to contract standpoint, that takes a little bit of lag. I think to fix pricing at current cost levels, it's going to take another bid season to get us there. So I think you're in the early innings. Now, if you're talking just about the spot market, who knows? Are you in the mid innings of what the spot market's going to do? I know it's cooled off a little bit, but still, I think 40% higher than it was last year. We'll see what happens back half of the year as we get into peak season. But I think as it relates to where we are, with intermodal, can be a laggard, where we are with contract rates, where we are with dedicated, and really the economics getting back in favor for a shipper to dedicate capacity, which would be really good for our DCS segment. I would say we're in the early innings of hopefully what we see in a freight economic recovery.
So Josh, our audience would like to know, there's been a lot of conversation about Tesla's electric semi. You guys have tested all sorts of technologies and powertrains. What is your view on electric in terms of the over-the-road segment? Do you think that electric, pure play electric, is going to be a big solution for the long-haul market? Or do you think we'll say it more regional?
From the long haul, not right now. I think still quite a bit of work needs to be done from more on the capabilities and to the cost. We are testing several different technologies in the ZEV space, and we still think there's certain applications where it can work, and it can work today, and we're going to continue to participate in those. But I still think it's quite a ways off from being able to be, a highly utilized piece of equipment, specifically in the long haul market.
Yeah, it feels like your last mile business might be the first that or dray around the port.
Or localized, dedicated, something where the infrastructure is readily available and easy, and they're hitting the same spots over and over again.
Years ago, I ordered some theater chairs for my home theater, and a JB Hunt truck showed up at my house to deliver those, which I thought was kind of fun because it's bringing not something you would have expected to see certainly 20 years ago, but you guys have a very large last mile business, and these JB Hunt drivers got out and did an amazing job. So
good.
So it's fun when we because we focus on the freight market. It's fun when you see the traditional truckload guys sort of interact with your life. So
I love it.
Yeah.
And my kids are like, "You're so cringe, Mom. Leave them alone. They're just here to do a job." When I'm asking them all the questions and want to hear all about everything.
And if you notice when you get in an Uber, I think like half the drivers the Uber drivers that I get in have some over the road experience.
Really?
Yeah. I think as my father, as Max has said on this show, is that one of the big competitions that they had for driver availability is just the for-hire Ubers and Lyfts and Instacarts that are competing for drivers, because frankly, you get to stay local and you kind of set your own hours. A little different environment, but that's just one more constraint. I think, Josh, to sort of wrap up the conversation, I think the fact that the driver situation is so tight. First of all, drivers deserve more pay. I think everyone in the industry would love to see when drivers are making more money, everybody's making more money. So it's something that I'm always happy to see when drivers make more. But I also think that creates a cap on how fast this expansionary cycle will overcorrect. It really will keep us honest, if you will.
Yeah, I agree with that. And again, I think there's going to be more competition for qualified drivers than there has been based on all these changes. And, driver pay took a really big step up. I guess that would have been in 21 and 22, and which the industry needed. And at that time, the economics certainly supported it. And you've seen some gradual increases over the last few years. I do think, Craig, you're right. It could be a limiting factor, and I do think pay will be addressed again this year to, again, attract the qualified talent that's out there, but you just got to have the right economics to get them.
Well, Josh, appreciate you coming on,
Thanks for being
sharing
on, Josh.
Your comments with us.
Always a good convo. I wish you would be on once a month.
We got to have him back once a month. I think he's got the blackout period. We should do is we need to go to Arkansas.
We won't talk about that. Oh, yeah.
We should go to Arkansas and do it around a game. I'm serious.
Y'all need to.
We should. We should go. We'll have to pick a date, and we'll come visit you, and we'll do a whole Northwest Arkansas, which is such a high concentration of fantastic supply chain. It's sort of the epicenter of North America supply chain. You have JB Hunt that's there. You have, and by the way, you have the Hunt School of Supply. I think it's the Hunt School of Supply Chain at University of Arkansas. You've got Tyson Chicken. You have Walmart, and then just because Walmart has such an impressive footprint. You have hundreds of consumer product companies
Totally.
that have operations inside of Northwest Arkansas. So
Yeah,
we got to do
lots of
that.
their vendors.
Put that on the list.
Josh,
What's
it was
best to do?
great. Thank you so much. We are going to take a quick break. Then we have a little surprise. Then we'll get into the sonar update.
The drivers, dispatchers, mechanics, and crews who keep the world moving deserve tools that work as hard as they do. That's what Samsara builds, technology for safer, more efficient operations, made with the people who do the work. Samsara, built with operators for operators. Learn more at samsara.com.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network. Billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Is that JB Hunt was on our first, Shelley Simpson, the CEO of JB Hunt,
First
was
week.
on the very first show. We are now into this, we're into almost done with our second month, but we also had another guest that kicked us off. He was our first guest ever. Webb Estes was on FreightWaves Today as our first inaugural guest, and he encouraged us to go do something. Let's watch this clip. And our first guest. I mean, not
very
only
first
first
guest.
episode, Webb, you know that first dollar bill? We need to have like an inaugural dollar bill or inaugural truck, I guess.
I will find a dollar bill and send it to you. I'm honored that you guys let me be a part of this. Thank you for all you're doing, and I look forward to tuning in every day.
We could hug a pallet. If
We're
we
gonna
did have
hug
a
a
pallet, we could
pallet,
hug
send you a
it. That's what
picture.
we need to do here. Send us a pallet. We need an Estes pallet that we can put here on set to represent. We'll hug it every morning.
I will
Again,
do that.
thank
Thank
you
you
so
guys so much.
Appreciate it, Webb. Thank you. So Estes delivered. Webb did deliver
on his
on
promise.
time in full. And we actually have the pallet here. So
So here we are.
Julie, we got to hug the pallet. So
All right.
How do you feel? I feel better. It brings out good energy.
Get some endorphins.
It does. I feel, hugs are always good, and hugging a pallet.
Yeah, I don't like hugs. I mean, like,
you don't like hugs?
I notoriously get made fun of by my team because,
you just feel weird.
Just hugging. Like personal space, yeah.
That makes sense. But look, we should hug pallets. I feel loved.
But I love this, and I love that it is representative, really, of what happens in our industry. These are the things that matters. The freight is getting loaded correctly. Our drivers are taking care of it. This is really what our industry runs on, right? So it's good to have a physical reminder sometimes. So thank you for holding your promise.
Est is delivered. No shock to anyone that's in freight. They always deliver on time and full. And we appreciate that.
All right. With that, we are going to get to the Sonar update. Good morning. I'm going to fill in for Craig today with our Sonar update, and the story is really about earnings and the implications that has on the overall trucking market. As you know, last week, J.B. Hunt reported on July 15th. We'll get the opportunity to talk a little bit more about that, but they showed a 19% year-over-year increase in revenue. They beat their estimates by nearly 10%. And intermodal was the engine there, really, with 10% volume, operating income up sharply. It was really a great story overall. We were able to get KNX earnings last night. They also beat expectations. Revenue was up 12.6% year over year. They beat consensus by over 20%. Their OR improved from 93.8 to 91.4. And they really attributed a lot of this to the freight market, to the regulatory and compliance issues forcing capacity out of the market and allowing more space for rate to increase for those compliant carriers. And they also spoke to double-digit contract rate gains, as well as increased spot rates and increased tender rejections. They specifically talked a little bit about how they were beginning to see contract rate increases in June and are continuing to see that in July. Our data really shows the same thing. Spot rates remain elevated currently at around $3.53 a mile on an annual average of $2.79. So while they've sort of plateaued at that $3.50-ish mark lately and aren't moving a ton, it's very normal. It's July, it is summer, and that's normal seasonality. We're seeing the same with tender rejections. They're sticking right around that 15.5%. They're at 15.44% currently, which is still elevated when you think about it in context beyond just the last couple of months. And again, very normal seasonality, but we are seeing contract rates continue to rise. We're at 269 line haul in the Sonar Index, and that's on an average annual rate of 241. And when you think about that and look at it going back to August of 2025, that's an 18% increase in 1 year, which is huge for contract rates to rise that much. So we're really still seeing tightness in the market. Another interesting headline I read this morning was that Brent crude oil hit $100 a barrel after the Red Sea attacks. Again, we can look at those fuel indices in Sonar, and we can again see that the retail rates are rising more quickly than the wholesale rates. So we'll see that gap for a little while until wholesale catches up. So an opportunity for people to play that gap if they are purchasing wholesale fuel versus retail. And you can see that in the Sonar chart as well. But I think the other big story of the day is that all of the railroads, not all, 3 Class 1 railroads reported, and really positive earnings overall. We can talk about that more in detail, I am sure, but the basic concept here, the overall, is Union Pacific showed 12% revenue growth year over year. CSX showed 10% revenue growth year over year. Norfolk Southern showed 11% revenue growth year over year. Both UP and CSX showed respectively 4% volume growth and 6.1% volume growth. So really, again, a really positive story for intermodal. I think we're seeing mode conversions. I think we're seeing more volume hitting the rails as truckload rates have risen. And I think an interesting point here is as well, that some of the quotes that came from the earnings speak to really strong consumer goods and industrial products. We've been talking a lot about the industrial renaissance and how strong carloads have been, but I think it was also a really positive sign to hear in the conference call the specific call out of the strong volume for consumer goods. And then one last point I really want to make that I think is a great one. We've been talking a lot on the show about if capacity will come back in the market, with this being a market, kind of unlike what we've ever seen before, where the tight freight market and the rising rates and high tender rejections have come from a decrease in available capacity rather than an increase in demand. So I thought this was a really good quote from Adam Miller and likely speaks to what we're seeing in some of the other large carriers as well. We've talked about it being harder to add capacity back, specifically for small carriers. Barriers to entry have been added, additional regulation before being able to get a CDL or a DOT number or an MC number. But here's the quote that I read in the FreightWaves article summarizing the earnings report. Before adding any new tractors, management noted that there is significant opportunity to enhance utilization, particularly since some trucks remain unseated. So just as we've been talking about, not only are we seeing large fleets sort of wait to add trucks to take advantage of this market, we're seeing it harder for new entrants to come into the market, but then that driver recruiting and retaining is continuing to be incredibly hard, which leaves some trucks continuing to be unseated at those large carriers. So I really believe that this is just another example of why this cycle is likely going to last quite a while, certainly in my opinion through 2027, and we'll see from there, but all signs pointing towards a continued really strong freight market where we expect contract rates to continue to rise, spot rates to remain elevated, tender rejections to remain elevated, and a really great opportunity for carriers to get back to being paid rates that allow them to be profitable.
So Julie, I think bottom line is markets are tight. Capacity is not going to be added quickly due to driver availability. And to talk about the Knight-Swift earnings, we have Todd Maiden, FreightWaves reporter, who covered Knight-Swift's earnings report. Todd, tell us what is your general takeaway from this earnings report for KNX?
Really nice beat, 23% earnings better than expected. But, it's really confirmation to JB Hunt's results last week that the cycle has indeed inflected. JB Hunt had some idiosyncratic things going on, taking market share, cost cleanup, that I think some investors were kind of speculative of, can we extrapolate that across all carriers and across the market in general? And Knight certainly delivered last night. And the best part, their commentary was even better, and the outlook for the rest of the year. Momentum built throughout the quarter, tender rejections, spot rates, contract rates, all up and to the right, April to June. Their tender rejection rate was twice the market average, which speaks to the strength of a large, well-capitalized carrier. And then all of the strength came in truckload. You look at across less than truckload, logistics, intermodal, mixed results there, but truckload drove it all. And the best part is the reason that more is on the come, as far as earnings is concerned, it was achieved through rate. You're talking about better utilization and cost takeouts, and just starting to see contractual bids that were inked earlier in the year bleed through to results. So as that continues to gain momentum and more of the book is repriced and actually implemented, all that's going to drop to the bottom line. There's not a cost offset to it. So really positive, and I think more so than the result is the forward-looking guidance.
Todd, I think my takeaway, if they're at 30+% rejection rates in their route, what freight is being tendered. We study the market. Obviously, Sonar is the place where people are, tender rejection data or OTRI and STRI indexes are the benchmarks of the industry. The obvious answer to a 30% rejection rate is that rate is a lot of rate momentum that is yet to come, because it means that they're under they're likely underpricing or have these old contract rates that are underpriced to market conditions if they're able to achieve those kind of rejection rates. That means a lot of rate increase is coming. I mean, that's clearly the takeaway here.
Well, and they spoke to that a bit. I can't remember the quote exactly, but I remember saying that they finally saw contract rate momentum starting to really pick up in some of those no bid awards at the increased rates the back half of June, and are already seeing it in July, I believe, as well.
Yeah, so and they received some pushback from analysts on the call. Rate per loaded mile only came in 6% higher year over year, but there's a lot of nuance to that. One, they said the bulk of what was implemented in the quarter was inked in January, February, when the supply side didn't look anything like this. They're seeing a ton of mini bids. They're also conducting a bunch of rate reviews on contracts that aren't scheduled to roll until later in the year. And they're going to bring those up to snuff to closer to market level sooner than the annual bid negotiation. But then you also had 28% of their fleets dedicated. So you have some of that's just tied to regular producer price index escalators. So that that was a little bit of a drag. But right now they're getting double-digit contract rate increases across the board. And their spot market exposure, if you're an investor, their spot market exposure is gapped up another 5%. It's up to 15% now. So they have that optionality to play the market through the rest of the year.
Well, I think one of the things that you see
closely managing tender acceptance on their contract very clearly.
If you're rejecting 30% and you're managing, as Julie says, the tender acceptance numbers, there are 30% rejections. You can easily take freight from the spot market, which I think is probably, Todd, the takeaway another takeaway is that they are shifting some of the capacity, perhaps from the U.S. Express operation, where it wasn't as tightly managed as the core Knight-Swift business was prior to their ownership in it, and therefore they're able to benefit from some of the spot market inflection when there's such a wide delta between spot and contract.
And then I also wonder, and I don't know how the interplay is now. I don't know how it's changed, but in
terms of disclosure, just to be fair,
yes.
you ran U.S. Express's dedicated operations, or you were a part of different operations inside of U.S. Express. Of course, our family office still owns some equity in U.S. Express itself. So, but in terms of operations, you were saying.
Yeah, and so I don't know how much of this they do at this point, but my intuition and what I would infer from the numbers is that a lot of that higher paying spot freight that they're able to pull on to the asset-based trucks is coming from logistics, because their logistics load count was down. Revenue per load was up, but their load count was down, and they still had a relatively compressed margin in that brokerage group. So I wonder if some of the high-paying freight that their logistics group books goes on some of the assets to continue
to the spot market, last minute.
Yeah, to continue to drive that rate per mile up with some of that spot freight.
Yeah, I mean, they don't talk about it specifically, but you're right. There's some cherry picking there. I know it occurs on the asset-based carriers that also have brokerage models. Absolutely, in a market like this, and like you said, 30% tender rejection rate. Those loads that come across their broker board, and they've already transitioned equipment into spot. They're absolutely jumping on those. Yeah, and I think. On the brokerage side, 350 bips of gross margin compression, but that was really in line with the rest of the market. And they've also had the added headwind. I don't think they were as far along as like a J.B. Hunt in their carrier vetting protocols, even though they're still within the group of brokers that's considered industry leading and kind of at the forefront of, getting out the bad actors over the last year plus. So I think they had a little bit of work to do, and that's why that load count was off a little bit.
So we talked a little bit just now about brokerage, we talked a lot about their truckload. What about LTL? We saw shipments down. Tell us more about their LTL report. Yeah,
tonnage was down, tonnage was up 4%, but shipments were down 4%. So the delta all came on an 8% increase in weight per shipment. So some headwinds there. They're being more selective on their freight mix. Which is positive for price, positive for margin. And they also enacted some temporary embargoes at certain facilities, and that was to maintain service levels. So the activity's out there, and as that freight that heavier stuff that was lost to truckload through the downturn to a depressed truckload spot market, that's starting to bleed back into LTL networks. So I don't think we can take a ton out of their volume trends. But what I will say is when you look at the other public carriers, your ODs, XPO, Saia, ArcBest, and you kind of aggregate their tonnage trends on a 2-year stack comparison, which takes out the volatility of what their prior year comps were, they all inflected positively in May and should have done further so in June. And we'll get June results next week when they all report. So LTL for Knight-Swift's a little bit more stable. They're still in the early innings of their LTL journey. I mean, you're talking basically 180 terminals added through acquisition and organic additions, buying from Yellow Corp's defunct estate over the past 5 years, but really a lot of activity in the last 2 years. And it takes 6 to 12 months to get a terminal to break even, and another 1 to 3 years to get it to where it's actually comping to what the rest of your network looks like on a margin comparison. So their story's a little bit of an outlier, but I think the trends are firming. Stable to firming is kind of how I quantify their LTL trends. But the broader industry is doing better. And we're talking multiple quarters. Nothing speaks to the health of the industry more than multiple quarters of mid-single digit contractual rate increases year over year. So high moats, high defensibility in LTL, and nothing's changed.
So Todd, the intermodal business for Knight-Swift certainly is not as bullish. At least the read on that is not as strong as what we got with J.B. Hunt and even the intermodal volume. Is there some takeaway that you have on some of the intermodal? I mean, look, there's been some improvements, but certainly not what we saw with some of the other. J.B. Hunt blew out their earnings largely because of intermodal. What is really Knight-Swift's challenges with their intermodal business?
So, yeah, some of that was comp driven. Between TL and the onboarding of LTL, I think it's more of a complementary service. It's not that big, not that impactful. I mean, you're talking about maybe a 5% revenue contributor, something that's been a drag on the earnings. So, as far as focus, intensity, what requires CapEx dollars and attention, it's all going to TL and LTL. So I think it's, whereas JB Hunt, I mean, as you know, I mean, they're leading intermodal first, dedicated first. There's kind of a race there for JB Hunt between which one will end up being bigger for them, dedicated or intermodal. But so I think it's just, their focus, it's a complementary service. They have some tailwinds. They control most of their dray capacity. They control most of the drivers. So there are some tailwinds, and as freight continues to convert to rail, they're certainly going to be able to participate in that. But they're just not one of the top players at this point to where it's going to jump out off the page and drive numbers.
Yeah, and while it was barely profitable.
Right.
I mean, they did see the volume grow in that segment, and it was huge improvement in their OR over prior quarters for that segment. So
yeah, I mean, look, it's interesting because we've talked about this before. Is that logistics businesses inside of an asset-based business, J.B. Hunt's logistics business is not remarkable. I mean, it's sort of average. It certainly isn't as good as some of the pure play logistics operations. You could argue that for Knight-Swift, it's the same thing, kind of an average operator in logistics. Logistics is secondary to the truck. I think at the end of the day, if you've studied asset-based models, and I think in J.B. Hunt's, what Josh said is that he works ultimately for intermodal. That's what pays his paycheck, not the trucking business. The trucking business for Knight-Swift is certainly the flagship.
Right.
The trucking business for J.B. Hunt is sort of the derivative of really empowering
have to have
your
that
overall
service
business.
to be able to
It's a
provide
single
all of those
source.
things to your customer.
And I think that's what my read is that ultimately Knight-Swift has the highest exposure, highest set of solutions in the over-the-road trucking business. and is a better barometer for the overall market than J.B. Hunt is, because J.B. Hunt is so well positioned for their business. That's why it's the best operator to own if you're going to own one, simply because it has such great exposure from all cycles. Knight-Swift is a much better signal to the overall freight market, and it tells us, my read on this, Todd, is that we're early. And I think that is what I would take away, is that this cycle is going to continue. 600 plus trucks that are down in terms of seated trucks. They're talking about how tight the driver market is, which does tell us that we're going to be here for a while.
All right, Todd, final question. What has been the market reaction to their release last night so far? I haven't been able to look much today.
A little down.
Investors maybe entering price for perfection. So I don't think everybody got the third quarter guide. There was also a little bit of pushback on why is it taking so long for your rate per model to inflect, which we talked about earlier. But here's the thing I would look at. All right, so the guide came in 71 cents in the third quarter. 71 to 77 cents, so 4% higher than the consensus estimate. And that's on numbers that continued to gap higher through the period. So I think there's a lot of conservatism in the guidance they provide. Their Q2 actual result beat their guidance by 34%. So I'm not saying there's 34% upside to the number they provided last night, but I think there certainly is some. And the thing is, everything like you've talked about is in front of them on the rate side. And I think the most important thing to take away from that drops through to the bottom line. There's no cost offset. They're not even at the point yet in this driver market where they need to raise wages across the board. They'll do it in select markets, but they're going to use better utilization to get more driving time and more loaded miles for their drivers, which will raise their pay. So there's really no cost offset. They have quarters here ahead of them where if we stay kind of where we are, get that seasonal improvement in the back half, the numbers are really going to inflect nicely. So I think everybody was a little concerned that the guide wasn't stronger for next quarter.
I think, like you said, everyone's expecting perfection. And I think if you've been around this industry, we can't have nice things. That's why everyone's very conservative. I also think there's been some softening in July. We've been talking about it all last couple of weeks, just the overall market. We're not seeing the momentum continue. And that's probably, made management a little bit more conservative, just to make sure that the momentum holds.
Yep.
Does tell you have a lot of hope over the next couple of quarters. Well, appreciate it, Todd. Great report. Always great to hear your thoughts. Todd worked on Wall Street. He did the opposite of Rachel Premack, Seth, and JP. He went from Wall Street to FreightWaves. But he's always a great someone to have on air. We'll be right back. We have Paul Tonsager to talk about, he's the CEO and founder of Integrated Multi-Modal Solutions. We're going to hear all about multimodal here shortly. Stay with us.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
All right, welcome back. Paul Tonsager argues the freight industry's own math doesn't add up. 20 years of growth stuck near 2.5% by his account. Joining us now is Paul Tonsager, CEO and founder of Integrated Multi-Modal Solutions. Todd, thank you for being here. Thanks for joining us. Tell us a little bit about what you mean about the math not adding up and where that sort of comes from.
Well, thanks for having me on today. And, it's a weird day to be a railroader. I've never seen so much happen in about a week time period, especially with the announcement last night. But the reality is, I wrote a lot of that a couple of months ago. But even listening to the analyst calls, the business, they're getting price right now. It's a supply driven situation for them, but the key is going to be, how are you going to maintain this? I think I just heard Craig say something that, from a trucking perspective, this is not, well, if you look at a year, is that short term, midterm, long term? But certainly, the railroads have been handed a gift that, for the next year or so, they're going to have the ability to bring in new customers. And is that going to be a price situation, or are they really going to dive in and put some meat on the hook and become customer focused, where they're going to maintain this freight that they're handling today?
Yeah, I think the announcement for our audience that may not be following the story, you can find it on Trains Pro, is really this this merger, this mega merger that we've got, one of the largest, if not the largest, merger in transportation history, the Norfolk Southern UP merger, which, by the way, we're going to cover in depth on Tuesday in our Future of Rail Symposium. We've got a jam-packed set of speakers, including the CEOs of both UP and NS here in studio, that will be talking about this merger. But really, it's the idea that CN and UP reached a settlement on the merger. Tell us a little bit about why, Paul, this is a big deal.
I worked for CN for 25 years and certainly with the Illinois Central Railroad. So I'm pretty familiar with all the players and it was incredibly smart. Up until this point, CN was frankly irrelevant in the conversations that were going on. In one fell swoop, they became relevant again. And they've talked about Kansas City and St. Louis, but from an intermodal perspective and a transportation perspective, I think the thing to look at is the EJ and E, which the CN bought, 15 years ago, but that's going to give the UP some fluidity around Chicago that they'll be able to not have to stop. And I think that will be one of the more underreported pieces of this. But certainly if you're BN and CP, CSX I'll put off to the side, but if you're BN and CP right now, you're rethinking things a little bit, I would think. And will this necessarily move the board into a more positive position? I've supported the merger all along, but I became, less of a supporter over the last couple of months because the reality is, they've moved, the chains have moved, but the ball hasn't. And certainly with the filings and things like that, it became more of a 50-50 situation here. But I think that this certainly has moved the ball, and now we'll have to see what the STB says.
But do you think you said you've been bullish on it, sort of two perspectives. One is the likelihood of it actually closing is sort of one perspective. The other question is it good for the industry? When you say you've been bullish, you've been pro it, where on those two realms, A, you support it because you think it's better for the industry and the constituents, and then B, in terms of what you think is likely to happen, I'd love to get your perspective on both those points.
Yeah, everybody talks about collaboration, and I know CP and CSX and BN and CSX. But collaboration has been tried before, and it's not worked. If you look in the past, IC, WC, CN. Now, granted, that worked just because of the merger situation, but the reality is, who owns the customer? How's the pricing set up? It's always in the details. And frankly, you never really get to see them. One thing I'll say is, part of my last full-time job was head of procurement at Maersk. And so I had all of the rail contracts. And, the reality is, you've got to negotiate with two railroads. In our situation was BN and CSX. Those were our main carriers. But in tomorrow's world, would the UP go to Maersk or go to a steamship line and say, hey, my assets are being stuck in LA. Let's talk about moving traffic from Norfolk to Kansas City or Norfolk to Minneapolis. There's so many more opportunities from a network position that will be out there now. And I think that's why I've been a supporter. I'm really skeptical on the 2 million truck diversion, going through the details of that. I don't know but they don't have to do 2 million trucks of diversion. I think from a network, looking at a network and being able to use St. Louis and Kansas City and other places that aren't able to be used today as an interchange point will free up congestion and hopefully service customers a little bit better.
Yeah, I think those are all really good points. I want to talk a little bit more about sort of your background and expertise and talking about the complexity of these railroads and them working together. And you talk a lot about who owns the customer in a relationship. Is that the railroad? Is that an IMC? Is it the carrier? So can you talk a little bit about that and then the role IMCs play in that?
Yeah, I mean, I'll talk mostly about the U.S., but the reality is, the railroads are wholesalers. CN has a retail product that they do up in just specifically in Canada, but for the most part, they're wholesalers. I mean, their customer is Schneider and J.B. Hunt and Maersk and CMA and Evergreen. The reality is most of these railroads have BCO facing groups, which is smart, but they're tactical. They're not, they're strategic, not tactical, I'll say, because the reality is they're not negotiating pricing with the big Home Depots of the world, the Walmarts of the world. I know Amazon's a little bit different now. BN is doing quite a bit with them, which I think is the right thing. But the reality is, again, they're wholesalers. So, you see the bumps and improvement in intermodal. They've already, it's up to J.B. Hunt, which I know you just had mentioned on the previous segment. And I would say they're best in class, but, BN's relying on them for any kind of volume improvement. So, the railroads themselves don't have a ton of control over the BCOs. They have control over their service. But the selling point and who owns the customer from an intermodal perspective, totally different than the carload side, are the IMCs and the steamship lines.
Yeah, Paul, you mentioned 2 million truckloads. This was in the application. Covering this market, it's just not a lot. I mean, it's about the equivalent of Knight-Swift's business. I mean, we're not talking a lot of truckloads taken off the market. But it does feel like a better product, frankly, from an intermodal standpoint, because you get transcontinental, and the IMCs will certainly benefit from that. But there's been a lot of pushback from the bulk, rightfully so, the bulk shippers. So where do you think this thing ends up? I mean, we're going to hear more about that from the STB. Obviously, they're not talking about the merger on our interview. I had the chance to interview the chair of the STB, Patrick Fuchs, and really what he had said that, he wouldn't give any sense of it, but it's just not it's just not a lot of volume moving off. But the bulk shippers are the recipients of sort of the downside.
Yeah, and I know Patrick, and I have a lot of faith in him and the STB, even with all the politics and the Supreme Court ruling and things like that. They will do the right thing. I mean, like you said, this is the biggest deal out there right now. Unless you look at SpaceX or some of the other things from a technology perspective, this is the biggest deal. I mean, and 3 or 4 people, unlike other countries in today's world, those 3 or 4 people will make this decision. It won't be the the Treasury Department. It won't be the FBI or Justice Department. It will be the STB that will make the final decision. So I think the biggest frustrating part, and this gets back to the 2.2 million trucks, is, used to be Wendy's. Where's the beef? I mean, I still haven't seen any specifics. Maybe I'm wrong. Maybe they're out there, but I haven't seen any specifics like, from Chicago to Kansas City or Oklahoma City to Atlanta. I'm going to take these specific truckloads off, and these are the customers I'm going to work with to do it. I mean, as you both know, the devil's in the detail, and it's a lot of hard work. And so I think that is really my open question on this. I think really with what happened with CN, again, I think maybe it's being promoted more than it actually means, but it was incredibly smart. And I think this changes the dynamics a bit. They just need to get moving. I mean, this thing is like a slow walk. This has been going on for a year. And, Jim Vena and I mean, all the CEOs and C-suite of railroads, they're pros. I mean, they know what they're doing. But the ball needs to move forward. So hopefully this last bit of application they give will satisfy the STB and let the games begin.
Yeah, it's going to be amazing to watch. As you point out, all these railroad stocks are AI.
It's crazy.
You
look at it, it's all... The only thing on the board it's green is GE and the railroad stocks. Crazy.
Well, they are AI investments. I think they're, frankly, better than a lot of the AI companies because they actually generate cash flow. Amazing to own a railroad.
Boy, cash flow, that's kind of a weird concept, but thank you for the time.
Well, appreciate it, Paul. We're going to be right back. We've got Freightonomics. Zach Strickland's going to get in and talk about railroad earnings. He's going to talk about consumer activity. He's going to talk about the economy, employment, all of it. Stay with us.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Huge thanks to today's OTR sponsor, again, OTR Solutions. They believe the right partner should know your business, understand your goals, and be there when it really matters. It's no accident that OTR boasts 4.7 stars on Google. They know that excellent customer support is at the center of every relationship. With responsive teams, industry knowledge, and a commitment to long-term growth, OTR gives customers more than service. It gives them a partner designed to help their business succeed. Learn more again with OTR.
welcome back to FreightWaves Today, the Freightonomics episode of FreightWaves Today. I'm Zach Strickland, head of market intelligence at Sonar, and this is the show where we combine freight market analytics and economics, tie them into one big supply chain bow, and bring them to you. Hopefully, the audience gets some knowledge for their existing profession or just their life in general. John Tesh style. So today we're going to talk about this intermodal's big summer. We've mentioned J.B. Hunt earnings in the past, obviously outperforming a lot of expectations, largely on the heels of intermodal growth. But also we just had some more earnings with Knight Swift. The truckload market continues to show some signs of strength as the market appears to be full on into another cycle, and it is an inflationary cycle for rates. So we'll break into that. And then, of course, I'm going to have Stuart Charles on here in a few minutes to break down what's going on with intermodal and rail. We had a lot of big rail stories come out today. You just heard Craig and Julie talk about it on FreightWaves Today earlier today, and it's going to be an ongoing drama, I think, with the STB and whether or not this merger gets pushed through. I think today was a pretty big step in that front. So without further ado, let's give you your market update in 2 using data to describe it. So in 3, 2, 1, we're off and running with the S-Tri. Sonar Truckload Rejection Index. It measures the total rate of rejection from carrier to shipper. Carriers do not like to turn down freight. So when they turn down freight for their customers, it's a big signal. We are operating just below 16%. We have come down from our seasonal high right before July 4th. But this trend line that you see on here, that's exactly where it's headed. I like to reposition this trend line because the tender rejection data specifically, really does a great job of painting a trajectory over time. Ignore the seasonal bump of July 4th, and we've got a nice straight line that suggests that we're going to be at elevated rejection rates throughout the rest of the year without issue. And that is pending on any other economic or weirdness, holding demand consistent. This is where we see the market going, and we're above 12.5% just in time for the holidays. Let's move on to the spot rate chart. This is where a lot of people live. Interesting nuance here, and the dry van rates coming down and continuing to slide down, but refrigerated rates finally separating here. RTI there in the pink type color there, starting to press higher, seasonally expected. We were wondering why these two were so well tied together or tethered together. It felt like the brokerage liability stuff was really having an outsized influence in the van segment compared to the refrigerated one. Looks like we're finally getting some of that breakaway here. Flatbed, the top line there continues to be the outperforming sector of truckload, and of course data centers and things of that nature, specialized freight moves still continue to drive a lot of that freight. So let's move into the demand side at the next chart, STVI. This chart does have me a little bit concerned, but I'm not overly concerned. We're in a seasonal slide in July where we see tender volumes falling down. They're falling down a little faster than I expected them to. But that doesn't necessarily mean that I'm that concerned about it yet. If we start dipping into that 2025 tender volume level, that's when we can start talking about, well, demand side economics aren't holding as strong as we thought they would. All right on the button. So that being said, I do have another segment here that I've been messing with. Anybody that works in logistics tends to work a lot with maps or things that obviously show pictures. And I want to have a little bit of fun with maps here because I know we've got a lot of brokers and people involving, the spot market that watch in our audience. So I want to show you guys a few pictures here that show you exactly where the market is moving, where we see consistent disruption, where some of the opportunities exist from a capacity perspective. The first map up here is just a heat map of rejections. So the dark blue that we have is where the highest rates of rejection are in the United States. Now, of course, this is volume agnostic. Lower volume markets, like in central Iowa, don't necessarily command the amount of outbound freight, so it's easier to move that rejection rate up. However, you can't really ignore it. It's not nothing when I talk about higher rates of rejection in low volume markets because you can see how concentrated this high level of rejection is. We're talking about like 30% rejection rates. So this is fairly consistent, and we've seen a real big rebirth of rejection rate in the central part of the United States. It's very ag-centric, it's very manufacturing, a little bit of Rust Belt activity. I'm sure you've heard Craig mention that a time or two, and it's continuing to be one of the most challenged areas of the United States. Looking out west, though, again, low volume Medford has been on the radar lately. I'm not saying that you can go out there and find freight pouring out, but it is worth noting, Maine as well, part of that same equation, low volume markets with relatively high rates of rejection right now do mean that there are opportunities. And again, when you're talking low volume markets, sometimes you can get exceptional rates or pricing opportunities out of there. The next map I want to pull up is probably one that most people will relate to a little bit more. So this is the van spot rate map. This is a heat map of where rates are moving up and down the most in the United States. The reds are where rates are moving down. For those of you that are Sonar users, you'll understand this. This is kind of the normal way that we view things that are coming negatively or coming down are in red. Darker the red, the more negative, the more lanes are coming down significantly. Blue are the ones where rates are coming up. And we see Medford out there on the map in the dark blue with some of the most elevated rejections and spot rates for van in the United States. And we've got that Northeast corridor, the backhaul centric area of the country for freight, showing increasing rates. Now, it doesn't mean that these are the highest rates in the United States by any means. It just means that over the last 4 to 5 days, these are where rates are increasing at the highest levels or the most significantly. So Dallas, Texas, it's kind of this central hub of the supply chain in the United States, or at least it's growing into that way, and Chicago. Also these connective tissues. We're going to talk about intermodal here in a bit. These connective areas where a lot of this freight leaves the railheads and gets onto a truck. Most all freight does this. Also areas of interest for the van market. Let's move on to the refrigerated, the reefer sector of the United States, and pull up the spot rate map for that. And you're going to see that the Northwest, very low volume, very uninteresting. 8 months out of the year, we're starting to get into seasonal produce moves out of the Northwest. So refrigerated activity peaking out there, or not, it's not quite peaking, but it's starting to get elevated and get more active as we get into the harvests. We have cherries, we have a lot of, obviously, apples and potatoes later in the fall, but other commodities, blueberries, all sorts of stuff comes out of this region. Raspberries, it's a berry season on its own accord up there. And so certainly one to watch. And then the Northeast again, showing up on the refrigerated side. This is fascinating to me because the Northeast has really been driven to a much softer state of being over the last couple of months because the predominant flow of freight in the United States is into the consumer centers of the Northeast corridor. The megalopolis, DC, all the way up to Boston, tends to command the most consumption. So therefore, there's the most freight volume moving into these areas, keeping it well supplied. So it is interesting when we see rates move higher out of these regions, specifically the Northeast and Northwest tend to be well supplied most of the year. When we start to see this percolate, definitely one to watch. And also Dallas, got to call it out again, sitting down there in blue. So that being said, let's move into the news stories of the day. And I'm going to break this apart a little bit because we have some guests that I want to get to here in a few minutes. But I want to break this up into a few sections. I have to talk about my earnings. Knight-Swift came out with earnings. You heard Todd Maiden talk about it. I have some takes here that I want to make sure that we get out there. But Knight-Swift has a fairly bullish outlook. I don't think that's a surprise to anyone watching this show. But if we look at their balance sheet activity, their income statement, some of their key stat takeaways here, the revenue was up for the truckload sector. But I think, to me, I'm seeing that revenue did inch higher, about 2.8% higher, but most of the gains were really in efficiencies. So their OR, their operating ratios, for the finance majors out there, that is the profitability of the operation. So operating revenue, less expenses, operating expenses. This does not include all the debt and interest and things like that. They ran about 91 OR, which was a pretty significant improvement in the truckload sector, by about 350 basis points. Over last quarter two of 2025. So I didn't see a huge amount. The miles are down. The loaded miles per tractor were about flat. Deadhead percentages were down. And then we have revenue ex fuel is up. So they had some pricing improvements. Maybe they messed in the spot market a little bit more so and got some gains there. I know they announced some contract rate increases. It does not take a lot for a Knight-Swift to move the needle there if they get a couple of percentage points. But I want to call out the fact that Knight-Swift has been making money. They were at a 94.6 OR in Q2 of last year. a notoriously soft period of time for the freight market. So they're really starting from a higher place, so a higher place of operational efficiency for sure than most other truckload carriers out there. Most of their ORs have degraded into the upper 90s, if not over 100, especially the smaller fleets have really struggled there. The TCA reported quite a decent amount of losses in their contingency last year. So the fact that these guys were already making money, that means that they don't necessarily have to act first when they're trying to come to the table to get some of these rate increases. They will come, and I think they're confident in that. I think they call out the fact that this regulatory pressure is unlike any they've ever seen. CEO Adam Miller makes sure to state that, and I think that is definitely something that's going to be ongoing and really contribute to the persistence and give Knight-Swift a period of time to implement some of these rate increases that they're probably going to get more strategically and targeted. So I have a bullish outlook as well for the Knight-Swift for the rest of the year. I think they can play it a little bit slower and safer than many carriers out there. The regulatory pressures, the broker liability stuff disproportionately influences smaller fleets and operations. Knight-Swift is the largest asset-based carrier out there, although they did get a little smaller. And I think that's an interesting tidbit in their statement that they are 600 trucks of their 21,000 truck fleet lighter than they were at this point last year. So capacity from the larger fleets has been shrinking, and that's a big deal. Some of their other segments, LTL, operated fairly flat consistently. They did improve their ORs. I think the LTL space is going to be a little lagged. Their sector, of course, also going through a few ups and downs in terms of overall operational strategy. It's a little too soon to talk about LTL in terms of a cyclical impact, I think, outside of fuel. Fuel cost influences and fuel revenues have been exceptional, largely due to the fact that most fuel surcharges in LTL are based on a percentage of base cost. So that's going to really produce some gains there. But I think LTL has a minute to also achieve some rate increases. The logistics sector, like most logistics sectors in 3PLs, margins contracted year over year due to the fact that their purchase transportation expenses are increasing. So just like Knight-Swift and J.B. Hunt and Schneider are charging more for doing business, they're charging more for other people sourcing their trucks. So that's anyone that's purchasing outside of their own assets is going to spend more money on purchase transportation. Intermodal, not as huge of a deal for Knight-Swift, not like J.B. Hunt here, but I think it is interesting to see that they did finally get some operational profitability. So that being said, I'm going to toss to a quick break here. And when we come back, we're going to discuss a deep dive on the rail intermodal. They have been booming lately, and I want to see Stuart Churl tell us all about what he sees for the second half of the year and how sustainable is it. We'll be right back.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D. To keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
All right, and we are back with Freightonomics, Zach Strickland, head of Freight Market Intelligence. I'm going to bring on our rail and intermodal expert. He writes for FreightWaves.com. Stuart Charles, apologize for leaving the S off in the previous segment, Stuart. But, Stuart, I want us to have a discussion today really centered around, let's talk about intermodal and rail and where they are right now, kind of paint the picture of where they've been over the last 12 months. And then we're going to talk a little bit about the current environment. We've had some big news recently. You've written some of those stories. So I want to talk about some of that regarding the merger and what that means for some of this moving forward, some of the service concerns. Are there any service concerns? Volume outlook, et cetera, we'll cover in the last part of this. But thank you for joining me today, Stuart. Let's get things started. So what has been your perception of the intermodal and rail? We've seen this huge growth over the last year. JB Hunt obviously cited it and benefited from it. Knight Swift now showing some of that as well. Well, how have you seen us get here? Is this a component of the truckload market tightening, getting some price increases, or is this just more of an organic growth for them?
Hi, Zach, and thanks for having me on. Well, as you well know, there's always a trigger point when trucking rates get to a certain point. Intermodal tends to steal more volume, so I think part of that is the story. I think we're seeing some organic growth because this rush to imports coming through, especially Southern California, is a situation unlike any other. Insofar as last year, now while there was a lot of tariff chaos, this year, we've seen similar volumes to the record levels of last year, and there's so much uncertainty. It really was, I think, somewhat of a surprise to the National Retail Federation that revised its outlook, and both the ports of Long Beach and Southern California, the busiest import gateways, who saw near record volumes in June, which was actually unexpected, and spoke to consumer resiliency that hadn't been realized before. So I think some of that was a surprise to transportation providers and became a growing benefit both to intermodal and to rail.
Yeah, and I want to pull up the chart, the domestic loaded container volume chart. This just blows my mind. I wrote a chart of the week about this. This growth in domestic containers. Now, domestic containers, of course, the 53 and 48 foot containers that operate largely in the United States, North America, not on ships that come across the ocean like the international. This growth right here is insane to me. I mean, I know the international does not mirror it in the exact form, but what's your take when you see this chart?
I mean, the numbers are what they are, but I think overall with intermodal, they're not in a runaway boom, but it has become healthier and more resilient than it was a year ago. I mean, domestic is a stronger part of the market, while international and trailer moves have been softer. But if truck capacity stays tighter and fuel remains elevated, intermodal should keep gaining share through 2026.
Yeah, I think too, one of the things obviously driving this, if we can pull up the savings index, the IMS CSI, as we call it in Sonar, and it's up around 31% on the average savings of the, when you compare the fuel and everything, all in rates for truckload versus intermodal. And Mike Bowdendistel, our former head of Intermodal Solutions, helped make this data point inside of Sonar. And this is, of course, nationwide across comparable lanes. It's not everything. But I think this is something that isn't necessarily sustainable from a relationship standpoint. Do you view this the same way? I mean, a 31% spread indicates that there's probably some rate increases inbound for intermodal later in the year, correct?
Just from the people I've spoken to, yes, I would agree with that. Intermodal now, of course, there's such a great aim on service by shippers, not just price. Mm-hmm. And service itself has been stable but not exceptional recently. And railroads have kept network speeds and trade frequency consistent, but shippers are still seeing reliability gaps compared with truck, especially on last mile drayage and terminal handoffs. So that's an issue where the supply chain is undergoing such changes and racked by tariff and geopolitical stresses that they really want to know that things are going to get there when they say they're going to get there. It's not just a price issue.
Yeah, do you think that may come into play? I mean, I showed you the domestic loaded container chart a minute ago, and it's not peak season for domestic containers moving on the rail. Do you think that the rails still have the chance to grow, or have we seen a peak season here? And then if they do actually peak later in the year, do you think that service then becomes more challenged or a risk?
I think it's more than apparent that we've seen a structural change with the peak season that's been driven mostly by tariff pressures.
Yeah.
There's a lot of talk now that the peak on the Trans-Pacific through Southern California ports has reached its zenith for this year as people try to beat the end of one tariff and the beginning of another. Of course, the Trump administration is preparing more tariffs based on forced labor issues across 60 countries, which is basically all our trading partners. And something that people may not be aware of is that there is another probe that's about to open by the U.S. Trade Representative based on excess capacity, also called anti-dumping measures. And that's something that lurks down the road, although there's some feeling that they'll hold off on that ahead of the midterm elections.
Yeah, I mean, that's, so a lot of this freight, of course, even though it's domestic loaded containers, we haven't really talked as much about the international stuff, but it feels like a lot of the maritime carriers are keeping these containers closer. You know, we also track the empty containers that go back into the ports. It feels like some of the maritime carriers are trying to pull a lot of those empties back and keep them closer to the coast. Do you think that also is driving some of this domestic growth?
Well, empties, of course, are always an indicator of what's coming in terms of imports from overseas. Right. But there's been some availability pinches across some ports. I remember I was looking at the Port of Oakland, which is a second-tier port on the West Coast, and they were showing no chassis availability. So if there's no chassis, then there's no point in containers sitting around. But we do know from the Port of LA's last media event that they see containers sitting about 5 days on average now before they move out by rail, which is about a day longer than they're comfortable with. They're used to a 2 to 4 day average, and now they're seeing a 5 day average. So there's some pressures that are being pushed onto the rails who are optimized networks, but they're stressing with even a slight surge. So it remains to be seen what will happen the rest of the peak season if there's that same kind of elevated volume closer to autumn.
Yeah, let's pull up the IOTI chart here, the inbound ocean TEUs index, which is, of course, bookings. So this is for all those 20-foot containers that have not yet left. It's based on departure date. So we have seen this. I don't want to call it a muted peak, but it's muted compared to last year at the same time, because that was obviously a bit of a pull forward and a recovery effort for a lot of shippers and importers trying to respond to the tariff stuff that you mentioned earlier. But it's not like been a robust, it's not a record breaking year by any means, but it is a little bit more consistent and moderated. Do you think that this is something that's going to continue to be, is it going to peak out and we're going to fall continuously, or are we going to maybe see a little bit of a continuation?
I'll just take a small issue with what you just said, because the Port of LA in June handled over 1 million containers, and that was only the third time in their 118-year history that they've seen that kind of volume, which is really remarkable. And no other container port in the Western Hemisphere except LA has ever handled 1 million containers in 1 month. So that's something certainly to take notice of. But
for sure,
this year it seems like the front loading is really, people, uncertainty in tariffs or not, they had to get their goods in. And there were also some producer price increases out of Asia in July. Now, the only thing to note is the shipping lines, who had set mid-month general rate increases and peak season surcharges, actually backed off on those. They didn't stick this year, which indicates a significant fall off in traffic heading in from July into August and what would usually be this growing peak season. So there's a lot of unknowns there as to what's going to happen, what the trend's going to be. But we've seen ocean rates on the Trans-Pacific certainly weakening or being more stable. as carriers have deployed extra loader ships to congested Asia ports to handle some of the surge. So maybe we're seeing a rebalancing right now.
Yeah, so you basically, I think to wrap this in a bow, rate increases are coming. Volumes are still going to remain fairly strong, though maybe not as strong through the rest of the year. We may have already seen a peak, and the international container flows coming in probably have seen some of their biggest strength. Is that about right? Do you agree with that?
I think that's an accurate assessment. The one thing we haven't mentioned was drayage, where capacity looks mixed to tighter, and spot running there running above last year while capacity continues to thin. A portion of that, of course, on the Trump administration's regulatory enforcement on commercial drivers. The national drayage spot market, the mid market update showed that it was tracking about 8% higher year over year, but also noted that capacity is still declining as owner-operators exit or consolidate.
Oh man, look at that. Intermodal and rail still tied to trucking. Still a limitation there. Well, Stuart, thank you so much for joining me today. And of course, keep reading FreightWaves.com to get more of your stuff and your ongoing reporting, especially since it doesn't look like supply chains are settling anytime soon. Thanks, and we'll be right back.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Could have taken more. Right, and welcome back to Freightonomics. This segment that I'm going to focus on is going to bring on a new addition here at Sonar FreightWaves. DJ Donahue, economist, is going to help me work through some of this economic data, as you know, it can be overwhelming at times, DJ, to keep all of these numbers and all this data. You know, I always try to pick out the most relevant data points that our audience I think can use. I think many people, such as myself, you know, we learned about economic data back in, you know, college, maybe a little bit in high school. but we're not really comfortable with a lot of the navigation of some of this information as people talk about jobless claims that we're going to mention here in a minute, housing starts. What does it all mean in terms of my day-to-day? Especially some of these business owners out there. I mean, if you're in brokerage and transportation, I think that the connections are fairly clear. If you're hauling freight, where does that freight go? What is its purpose? Is it building a house, or building a data center? Is it consumer goods, the stuff that we all buy, come off Amazon? So I think that's really one of the big reasons why the focus of this show is to help people understand what this all means in the form of their business and their day-to-day. And sometimes it doesn't have to be freight related at all. And I think that also helps describe things. So the first data point on Thursdays, we traditionally cover this data point when it matters. And I think this call out, we were talking about it before the show. Biggest drop in jobless claims that we've seen. Now, the headline of that obviously is alarming. And I think there is something to it. Jobless claims have been, this low hire, low fire rhetoric has been the dominating headline for the labor market and labor figures. This looks in line with that, but what is your take on 187,000? I think back in the day, Anthony Smith, one of our former economists, would say that 210 to 215 is about normal. That's kind of basis. And we've been averaging around that, and I think they expected it this week. But what's your take on this week's 187?
So the 187, I got a couple things that come to mind. First off, looking at this graph, we're seeing a drop recently in initial jobs claims, which is true, which is good news. We don't want to see people going for unemployment claims. And this is for claims of people who are filing their unemployment for the first time. So they just got laid off. They're just getting ready to file for unemployment. This is the first time they're calling in for it. We see that there is a drop, similar line since it was about middle 2022, I think it shows on the graph. And we're seeing headlines saying that this is the lowest level that we have since 1969. We kind of have to take this with a grain of salt for a couple reasons. One, job numbers are incredibly volatile. We have to worry about them being revised after the fact. We heard big uproar sometime last year over a very large revision from Bureau of Labor Statistics. It came down from the administration. Everybody was upset. So these numbers are going to get revised in all likelihood. So it's good, but don't bet the farm on it just yet.
Right.
Second thing I'm worried about is that when we see this, we also have to keep in mind that there is another side to the unemployment numbers. When we're talking about unemployed numbers, we're talking about people who are unemployed and actively seeking work under BLS definitions, right? And so that does not include people who are actually out there able to work but aren't actively seeking employment. What we call these are not in labor force numbers.
Right.
And what we're starting to see with those numbers is a continuing drop in the not in labor force numbers. So that means that people who are above the age of 16, they're able to work, but they're simply not looking for a job. Those people are getting larger and larger in terms of percent terms, and we're approaching the low point of the Great Recession. So right now our numbers are coming in close to 59%. I think it bottomed out at a little about 58.3 in the Great Recession, according to the Federal Reserve. So we're seeing a lot of these drops in unemployment claims, true, but it could be simply that they're dropping out of the labor force entirely, which is a whole nother side of the story we got to worry about.
Yeah, so basically the numerator and denominator are falling.
Exactly.
And that that's a big portion of the story. We've mentioned this on this show. Dr. Zach Rogers a few weeks ago, he talks about demographic cliffs as well as immigration, obviously the one that everybody is thinking, it's top of mind. But unemployment remains limited. I think my big question here to you is, what are obviously low jobless claims, good, take that for what it is. Is there an inherent risk though with this participation figure that we need to be thinking about? Is this inherently bad, good, indifferent? Are there goods and bads to this participation figure dropping like it is? What's your take here?
I wouldn't call it necessarily good or bad. It's simply something that is.
Right.
We could be seeing that there are, we've got to think about this in terms of active participation. So we're seeing, demographically speaking, a lot more people are retiring. We're seeing the boomers retiring. We're seeing large unemployment numbers themselves among lower lower age people. So the very young more frequently now don't actually go out and get jobs when they're young. I mean, I don't know about you, but I was working since I've been 14.
Right.
And a lot of the younger people in high school are simply not going out and getting those first jobs, which ties in with minimum wage issues, but that's a discussion for another day. We're not going to have time to get into that today, I don't think. But it's not necessarily bad or good. It's simply that is what is.
Okay, no, I love it. That's a great take. I think people don't think about who's all involved in the labor force. It's not all one thing or another. It's a mixed bag of things to talk about there with participation. So I want to move into the housing sector because there's an article on FreightWaves that Eric Coolidge wrote that talks about a weak housing market hurting big and bulky last mile delivery. Now, I've worked in freight a long time, and I have never, not since I was 14, but I've never really, I didn't put this together that as the housing market goes, this final mile sector, which the final mile is a rough name for this box truck type operation where a lot of retail freight or freight that's going to job sites or things that are kind of off the beaten path sometimes go that aren't necessarily full truckloads. And they're refrigerators, they're appliances going to new construction houses or even old construction houses. And this sector heavily dependent on these big, bulky appliance type items. We just had the housing starts that we just had actually were fairly positive overall. Like we saw big growth, but the caveat to that is that it was multifamily. It was almost entirely multifamily driven, which is going to be your apartments. This has been a glut in terms of availability over the past several years. They overbuilt apartments. I've heard them discuss this a lot of times on CNBC. And then we have a negative growth in single family housing starts. So when you're thinking about housing starts and you're looking at these figures, you're hearing the reports, thinking about freight and last mile delivery or appliance delivery and things like that, multifamily doesn't necessarily have the strength of influence there that the single family, correct?
It doesn't for a couple of reasons. One, when you're talking about a multifamily housing dwelling, you're talking about places that a lot of times will not have a lot of the appliances you're looking for. They may not have washer dryer hookups. They may not have like a space for a separate freezer or something. More importantly, they're already coming with like their own stove. They're already coming with their own refrigerator. They're already coming, sometimes even furnished with furniture. So the furniture would come by a box truck. That's not going to be coming either. So the multifamily housing, while the numbers are showing that it's increasing, and it's not surprising that it's increasing given the fact that what we're seeing with interest rates. We're still seeing high interest rates in the market relative to what we saw before COVID with the QE2 expansion and the monetary supply. It's not surprising, but it does all fit into the same story that the box trucking sector is going to kind of lag behind a little bit when you have new home starts in the multifamily sector over the single family sector. And we're starting to see a lot of that from a policies perspective too. You see a lot of areas now pushing against what we call NIMBY policies. Have you heard of that term before?
No.
NIMBY stands for not in my backyard.
Okay.
And there are a lot of aesthetic places like we like to have the single family housing sectors, these nice subdivisions where it's all a bunch of single family homes. But unfortunately, the single family home market can't necessarily sustain the amount of population we need. We need to have more multifamily housing in a lot of places. So you see places like, I think Austin had a good experience with it. You're seeing California legislation where they are streamlining the building process to enable it to increase the amount of housing that can be built on a regular basis in order to put more people in denser areas.
Right, and we've already seen this in Europe. Like it's a natural progression. Once you build out an area or a region, you tend to start having to build on top of other things.
Exactly.
And so I think this is necessary. And do you think that the interest rate environment, though, is also, you mentioned this, but I've read about there being a building kind of almost a oversupply in the single family housing, or it's not necessarily an oversupply, that's probably the wrong term, but they've increased their availability over the last couple of months in terms of how much inventory is still there for the single family. Do you think the interest rates staying elevated, kind of a stagnant job market, is keeping that figure relatively low.
I think so, because your interest rate is really going to drive what your mortgage rates are going to be.
Right.
And so if you've got a very high mortgage rate, what we're talking about is how much money does it take to borrow? How much additional money do you have to pay to borrow money from a bank in order to pay for your mortgage? Because if you look in a lot of other countries, the idea of a mortgage doesn't exist. They say, okay, you just have to save up for a bunch of years and you pay cash for your house and then it's yours.
Right.
Whereas here in the US, we have the mortgage system where you promise to pay a bank, the bank fronts the money for you, and you pay them the interest on top of that in order to borrow the bank's money and pay for the house, and you live in the house while the bank pays for it. And you pay off the bank over time. The interest rate being high means it gets much more expensive to borrow that money in order to get the bank to loan you the money, give you the funds to where you can buy the house and live in it.
I mean, since the 10-year, I believe, is still at like a 4.6 as of this morning, that's relatively high to where it's been. And of course, the mortgage rates tend to move in conjunction with that. Do you see interest rates moving lower without the Fed doing something here? Or is this you see this as being a pretty sticky situation?
I think we're getting used to this becoming the new normal, because when we're looking at inflation rates, they're getting, the original goal prior to COVID was a 2% inflation every year.
Right.
And that's tied in with the interest rate as well, because the more money you print, the more loanable funds you have, and it's all tied together. But I think we're going to be seeing, with the big increase in the money supply through the CARES Act of 2020, that what we're seeing now is going to be kind of the new normal for a while, because it was the low interest rates we saw over the last decade were really tied in closely, I think, with the monetary expansion coming out of the Federal Reserve, QE1 and QE2. That's quantitative easing, what they called it. They pumped a lot of money into the money supply through bond purchases. And so as part of that, they made a lot of loanable funds available, which drive down interest rate. Now we're seeing more money in the market. We're seeing the market kind of catching up with that. And I think that with inflation going on and catching up behind that, we're going to see high interest rates.
Continued troubles. Well, thank you so much, DJ, and thank you for watching. Tune in tomorrow for more FreightWaves Today.